What if I was to tell you that there is an area of the country with a property market that is set to increase in value by 31.2% by 2029, and it's not actually where you would expect it to be? We've spent over 20 years now identifying where the next property hotspot will be, where you should put your money today to have the best chance of the highest levels of capital appreciation in the coming 5 to 10 year period. We regularly see investors making the same mistakes over and over again by buying into the areas that have already made the headlines feel extremely familiar. But actually, this isn't always the right way to go about it. And what they're doing is missing out on being able to put their money into an area where they could literally double the returns of buying the obvious and predictable. In this video, I'm going to share with you where I would actually put my money if I was starting fresh as a property investor in 2026, and how you can get started stronger, earlier, and move yourself into a better position to really take advantage of growing a high quality portfolio quickly. Before I show you exactly where you should be looking to deploy your capital for an investment property in 2026, we need to address something that's probably holding you back right now. Most investors believe that in the UK, it's either buying in London or buy nowhere. They believe that if you're not buying into the capital city of the country, you're maybe settling for second best, or that maybe you'll struggle a little bit with tenancy and it won't provide you with the returns that you're hoping for. They think that you need to be wealthy just to get started, or that you have to be looking to try and buy the smallest and cheapest properties in an area like London to make those real juicy returns. That's actually not strictly the case. And one of the more common patterns we've started to see is people who have grown fantastic portfolios of properties in London over the past 15 and 20 years and seen incredible price growth, fantastic yields, and now have assets worth significantly more than they paid for them, are beginning to say, I'm looking to sell up my entire portfolio of properties in London to be able to deploy my capital to work smarter for me. What do you have, and where do you think I should put those funds? And the answer for me would always be, you need to move the money from London up into the north of the country, where it's going to work significantly harder for you. I had a client who was achieving around about a 3.5% yield. He was also seeing price growth of 1 to 2% a year. If he deployed that same capital into the north of the country, he could potentially be looking at buying 2 properties instead of 1. And not only that, his money should be working for him at a rate of 6 or 7% yielding and 5 or 6% per year in capital appreciation. So not only has he got the ability then to spread and purchase more assets quicker, but also the assets he is buying are actually going to provide him with significantly stronger returns. The London first mentality is becoming outdated. While London was, of course, the obvious choice for many years whilst it was growing, the market there is now saturated, slowing down and becoming a little bit more stagnant, while cities in the northern end of the country are absolutely thriving, undergoing huge regeneration, major changes in transport links, big businesses moving out of the south and moving their offices into the north of the country, fantastic employment rates, and people actually graduating from university in the northern cities, and rather than going to London to get their high-flying job, they're staying in the north because the high-flying jobs are coming to them. And of course, that massively benefits you as an investor owning property in the north of the UK. The belief that you need to be wealthy or start at the bottom can keep people on the sidelines for years. All that does is cost you time and money. Starting small often means starting slow, which can cost you more in missed opportunities than it actually saves you. Strategic decision making actually matters significantly more than the size of your wallet. And the sooner you get started, the sooner you make your first purchase, the sooner you start making your returns, the sooner you can save to buy your next purchase and begin the compounding journey. Stop thinking, look at London first, and start thinking, look at the data first. Now, don't get me wrong. I'm absolutely not saying London is a complete no-go for buying property, but even a bargain by London standards is extremely expensive by the array of opportunities you have in the rest of the country. I'd always say avoid some of the more obvious and popular options if you are going to be buying into central London. The really predictable stuff comes with an incredibly high price tag and an incredibly low yield. I would look at some of London's regeneration zones, looking for the really good and easy transport links to get into the city, but those areas outside where property prices are just a little bit fairer and you can still actually get some kind of yield that is worth chasing. An area we've seen explode recently is Battersea, where there's fantastic homes being built and it's an easy commutable distance into the city. I've spent the last few weeks analysing investment property data from across the UK. And if you want to cut through that research for yourself, we've developed a handy investment finder tool that you can use to assist you in finding your next property. It will show you the highest growth areas based on your investment budget and what you're looking to achieve. The link is in the description below. Now that we've explained a little bit about the common mistake some investors still make, let's talk about the more exciting stuff, where we believe will be the next place you should put your money to capitalize the best you can from the investment property market in England right now. Most investors still think that regional cities are backup options when you can't afford to be purchasing in the capital. They assume that the real money is still made in the capital. And as I said before, it can be, but there are 101 other places where you can do just as well, if not significantly better, by buying the right product in the right location. I have a client who owns multiple properties in both London and Manchester. The property in London is, as you can imagine, extremely expensive and ties up a very large chunk of capital and is a mortgage-free property. The properties in the north of the country are also mortgage-free, but tying up significantly smaller chunks of capital because of the prices. He's made a decision that the smart thing for him to do would be to sell up the property he has in London, move that capital in the northern cities where he can buy 3 or 4 nice properties and significantly increase both the capital appreciation and the rental yield coming out of that same chunk of capital. It becomes a no-brainer, right? Here's what the data actually tells us. Regional cities, particularly in the northwest, are considerably outperforming places like London. If you take, for example, the statistics from Savills, a massive property statistics company, which shows that cities in the northwest are expected to increase in value by 31.2% by 2029. When you look at the same statistics for London, it's looking more like 17.1%, which means simply by choosing to put your money into the northwest of the UK rather than London will give you double the appreciation in your asset over the next few years. With London, yields are sitting at an average of 4.1%. When you move into a city like Liverpool, they're averaging anywhere between 6.5% and 8.5%. And when you look in Manchester, anything between 5.5% and 7%. Again, significantly higher, and in some situations, almost doubling the yield that you would see in London. And that's not where it stops. Birmingham, expected between 6 and 7.5. Leeds, coming in at an average of 6.6. Even Bradford, Nottingham, and Newcastle are all performing at a higher level than you would see virtually anywhere in the south of the country. Comparing those stats to London's 4.1%, makes it very clear and obvious why the smart money is moving into the north of the UK. But it's not only about yields. The cities in the north are currently benefiting from billions being spent on major regeneration. And as we all know, if you follow the major institutional money being pumped into the regeneration of major cities, that's the real trick to making the best end of capital appreciation. Think changes in transport links. Think brand new big businesses moving into areas. Like, for example, in Manchester, when we saw Media City be launched. Next thing, BBC move in, ITV move in. And the whole property market in the surrounding area feels the swell of appreciation from that. And even now, where we see the same companies responsible for Media City totally redeveloping Liverpool's business district at a cost of 5.5 billion. I'm sure you can see what we're expecting to happen next, which is a massive boom anywhere near the northern side of Liverpool city centre, where this big regeneration project is currently taking place. And of course, when you invest into these major regeneration areas early, before the full impact of the regeneration hits the property prices, that gives you the biggest room to maximize the potential appreciation that can come from your purchase. And not only that, naturally, as these areas regenerate and everything comes to fruition, what you'll find is the rentals in the area will, of course, increase loosely in line with the increases in property values. So if you've bought at that earliest stage, your yield potential will also increase, which is just a win-win from both sides of the investment returning coin. The affordability also matters too. Regenerating cities, of course, offer significantly lower entry pricing to be able to actually buy into the cities. So rather than spending significantly higher sums of money being able to get into fringy areas of London, you could spend lots less to be right in the center point of the major regeneration areas of major cities, which of course means your capital goes a lot further. This in turn means you can build a stronger portfolio quicker. It gives you the ability to buy more assets and take advantage of the compounding that comes from that. And of course, once you own these assets and the value increases start happening, you have a bigger pool of assets to refinance and use financial gearing to accelerate your growth even quicker. So the advice I would give you is focus on areas in the northwest of the country. Buy into cities like Liverpool, cities like Manchester, or even Warrington. Another really interesting place right now because of the huge regeneration it's about to undertake. Look for the areas, as I said, near to the big transport link changes, near to the big new employers or big new sets of office premises. Or if you're thinking about going after a short let model, you could even look as near as possible to all of the tourist attractions. And not only that, when you are going to buy your property in Liverpool or Manchester, and you're going to be buying at the earliest stages of that regeneration, you can also do something else to maximize that potential for cheaper pricing and more yields even further. And that's buying off plan. If you buy a building during the construction phase in one of these new areas, you should see discounted prices of somewhere between 10 and 15% below the market value. You'll have the pick of apartments in the building, not just an apartment that somebody has listed and is willing to sell. And also, the buildings will come with 10-year structural warranties, warranties on your white goods, and a completely new asset to take ownership of, which again will boost the potential for rentals. So don't wait for these cities to catch up with London. Of course, that process is already happening. Buy in now while you have the opportunity to take advantage of those prices being just that little bit cheaper. If you invest while they're still affordable, the fundamentals of the potential growth don't change. This means waiting is only ever costing you money. It's one thing to know where to invest, but it's another thing to know exactly what property you should be buying in that area to match with your goals. That's why we've developed the Property Investment Finder tool. It doesn't just show you where to invest, it also matches you with specific opportunities in high growth potential cities that can work for your strategy. Click the link in the description below to learn more. Beyond knowing where is the best place to invest, it's also important to know how do you turn your property investment into a reliable source of income that can replace the income from your day-to-day job. And that's exactly what we're going to cover in our next video, which is going to show you how to retire at 55 years old with £5,000 per calendar month from passive income from your investment properties.